Are we on the brink of repeating a 1979 oil crisis 2.0? So this is what happened in 1979. The crisis began after the Iranian Revolution disrupted oil production from one of the world's largest exporters. The sudden drop in supply tightened global markets and caused oil prices to surge. In the U.S., the effects were immediate. Gasoline shortages led to long lines at gas stations across the country, one of the most recognizable images of the crisis at the time. Fuel rationing appeared in some states, and higher energy costs quickly filtered into household budgets. The oil shock worsened inflation during a period already marked by economic instability. Rising energy prices pushed prices higher across the economy, and the Federal Reserve later raised interest rates sharply to bring inflation under control. The crisis also reinforced the need for U.S. energy security. Although the Strategic Petroleum Reserve, or SPR, had been authorized after the 1973-74 oil embargo, the 1979 disruption accelerated efforts to build it as an emergency stockpile to protect the U.S. from future supply shocks. Today, markets are again reacting to geopolitical risk. The Strait of Hormuz, located between Iran and Oman, is the world's most important oil checkpoint, with roughly 20 million barrels of oil flowing through per day, or about 1/5 of global consumption. Following the closure of the strait amid conflict involving Iran, oil prices have surged as of March 6th. West Texas Intermediate crude is trading around $86 per barrel, up sharply from $77 just a day ago. Steve Hanke, professor of applied economics at Johns Hopkins University, joins us now to discuss what's next for oil and the world economies. Steve, welcome back to the show. Good to see you.
Great to be with you, David.
First question, Professor. How close are we to getting a second oil crisis, the likes of which has not been seen for almost 50 years? And what's next?
Well, let's go back just a little bit before that to put me in context. The first faculty position I actually had was at the Colorado School of Mines, world's top mining school, obviously. So it was a great place. And I taught the first course that was ever taught there in petroleum economics in the late 60s. In 1968, actually, the second book on petroleum that I edited was produced in 68. That's quite a while ago, David. And it's called, for your reference, Political Economy of Energy and National Security. So the topic was exactly the one that we're talking about now. That was about almost 60 years ago. So at any rate, moving forward, then in 1985, late 1985, December of 1985, I had developed a plain vanilla model of OPEC, the oil cartel, and it looked to me like it was going to collapse. And I predicted that oil would drop down below $10 a barrel, which it did after OPEC collapsed in 1986. And looking back at the time, I was at Friedberg Mercantile Group up in Toronto, and we had very big short positions based on my analysis. We ended up with over 70% of all of the short interest in the London market and the gas oil contract. So let's go to 78, 79. Or should we go to 73? We had an OPEC embargo then. And gas prices did go up. We had gas lines. It was all very much aggravated because we had price controls. So that posed a problem, at least in the United States. Now, if we go to 78, 79, let's look at the situation now versus then. And I think the potential for disruption is lower today than it was then, David. And the reason for that is that Iran in 1978 was producing 8.5% of all the world's oil production. Now they were producing at 5.2%. So that's less of a disruptive factor. The Mideast 1978, they were producing 34.3% of the world's oil, now 31. So they're less of a factor than they were. And the U.S. was producing 15.6% of the world's oil in 78, and now we're up to 18.9. So we're less dependent on foreign production than we were then. Another big factor that makes things better now than they were then in 1978, 79 is that the oil intensity, the amount of oil that we use per unit of GDP is declined dramatically from 1.5% down to 0.4%. So that's in the picture. Now, there's a lot of narrative being spun in the newspapers and article after article, which is all wrong, and that is that the oil price increase is, which we've had, by the way, the oil price in the last week is up, a little over $17 a barrel for WTI, West Texas Intermediate. So the price has gone way up. Gasoline prices have gone up. And there's a lot of chatter about, well, this is going to be very inflationary. No, it isn't inflationary. It simply means that the price of oil and gas and items produced from crude are going up in price relative to everything else, but it doesn't mean we'll have inflation. And the best example to make this point is that look at Japan. Japan, of course, imports all of its oil. It doesn't produce oil. And in 1973, the price of oil shot up with the embargo, and the Bank of Japan accommodated that price increase by increasing the money supply, and not only the price of oil went up relative to everything else, but Japan got more inflation. Then in 79, of course, we had another oil crisis, and what happened? The Bank of Japan said, no, we're not going to increase the money supply to accommodate this. So you had the price of oil going up in Japan, but it wasn't accompanied by inflation because the Bank of Japan never goosed the money supply. So inflation is always and everywhere a monetary phenomenon. You have to look at what's going on with the money supply. And that is a causal factor behind inflation. It doesn't mean that we won't have oil and gas prices going up relative to everything else. That's happening as we speak today. So there you have my take on the thing. The potential disruption is, on the face of it, in the United States less than it was in 1979 for the reasons that I gave you. Now there is one factor actually that makes things worse, more vulnerable, and that is that the stock market is in a bubble. It's in bubble territory, and it wasn't in bubble territory in 1978. The PE ratio was 8. Now it's up in 29, 28. So when you're in a bubble, obviously the bubble's always vulnerable to an external shock. But surprisingly, we haven't had, the market's taken a hit, the equity market, but I think surprisingly the hit's been pretty small given the vulnerability of the market due to the fact of very high and elevated valuations. So that's kind of a summary of where we're at. Now, where we're going, as they say, that's a crystal ball exercise. But one thing that also might mitigate things is that right now there's a tremendous amount of sanctioned Russian oil in the shadow fleet, just sitting offshore in storage, basically, that they can't sell it. And already the U.S. has started to pivot and lift sanctions
That's
on
right.
some of that Russian oil.
They did
India
that
now,
exactly, just last night on India. Yeah, let's talk about that.
yeah, they just did this. So this is kind of ironic. The, Israel and the U.S. start a war with Iran. It creates a huge disruption in the oil market, and they're forced to do what exactly I thought they would do, and that's pivot towards Russia and allow some of that Russian oil that's being stored in the shadow fleets, and there's a lot of it, by the way, to be offloaded and sold. So that would be the quickest way to mitigate this acute problem that we're in right now, and it is getting more acute by the day, because earlier this week the Iraqis shut down their biggest oil producing field because they storage tanks are full and there's no way they can offload the oil into the Gulf, into vessels, tankers, to take it out of the Gulf, because the Gulf's basically shut down. And today Kuwait is shut down for the same reasons. Now that does create a problem, because once you shut an oil field down, there's potential damage that accompanies that. So it has all kinds of costs. The basic line, the David Lin show is involved with finance and economics, and wars cost a lot. There's a lot of collateral damage and huge cost.
Before we continue with the video, I'd like to bring to your attention a company operating within the battery supply chain that some investors may have overlooked. Today's sponsor, Nouveau Monde Graphite, ticker NMG, is a Canadian company developing advanced processing operations to supply carbon-neutral graphite materials for lithium-ion batteries. Graphite represents more than half the weight of a typical EV battery, yet most of the global supply chain today is concentrated in China. NMG is developing two main projects in Quebec: the Matawini graphite mine near Montreal, and the Bécancour battery material plant located in Canada's growing battery manufacturing hub. To support that project, the company recently acquired a large industrial brownfield site in Bécancour to help accelerate development and support an anode material supply agreement with Panasonic Energy. The government of Canada has also signed a 7-year offtake term sheet for up to 30,000 tons per year of graphite concentrate from the Matawini mine, including a take-or-pay commitment and profit sharing above a fixed North American price. Go to the link in the description down below or scan the QR code here to learn more about the company. And as always, don't forget to read the filings and all the risk disclosures before making any investment decisions. Yes, this is what the government in the U.S. had to say about the current situation. This was actually 2 days ago. So Treasury Secretary Bessent has said that, importantly, we have a series of announcements that we're going to be making. Now, keep in mind, Professor, we're speaking today on the 6th of March. As the Strait of Hormuz has closed, and by the way, roughly 20% of global oil traffic flows through the Strait of Hormuz, so that's closed. As of today, the oil price has shot up to $86 a barrel. It was just at $77 last night, and it was a little bit lower a few days ago. So now the U.S. is facing a situation where the oil prices are going to be a lot higher. Still, if the situation isn't resolved anytime soon, it's already higher. They don't want higher gas prices at the pump. What can the government do to stabilize gas prices for Americans, short of price controls?
Well, I think the first thing to do is what they started already doing, pivoting towards Russia and taking the sanctions off Russia. That would be step one. No, and
just on step one,
would be good. Yeah, go ahead.
How will American allies respond to the lessening of sanctions on Russia? And how is this going to impact the Ukraine war? This is sidestepping away from Iran for a minute, but since we brought it up, this is important.
Europe is getting hit big time with increasing energy prices.
Yeah.
And they're suffering anyway, because remember, with the sanctions that the Europeans have put on Russia, as well as blowing up Nord Stream 2, they've cut a lot of the supply of natural gas uh, off that's coming from Russia into Europe, and as a result, the Europeans are having to buy LNG gas, mainly from the United States, cost about 3 times more than the cost of the Russian gas was
Well,
costing. So they're hurting. They're in a big corner. So I think the idea of pivoting towards Russia might be something they can, shall we say, swallow by holding their nose, if you know what I mean.
okay.
That's
More on that later. Yeah,
that's what
back to
I'd
oil.
recommend. Of course, I recommended no sanctions in the first place, but that's another story because
Well, is there an
I don't
alternative?
like don't like I don't like sanctions on
That's right.
anybody anywhere anytime. I don't like tariffs anywhere anytime. I don't like quotas anytime any place, and I don't like non-tariff barriers. I'm a free trader.
Will the strategic?
I'm for free enterprise and free markets.
Mhm. Do you think the strategic petroleum reserve will finally be drawn down now? Isn't this the exact scenario for which the SPR was created in the 70s?
Uh, they could do that. That is why that's what it's supposed to be used for.
Right. Would that be enough? I think currently the Energy Department reports roughly 413 million barrels in the SPR. Would that, withdrawing that down by even, 2 million barrels at a time, would that help gas prices, you think?
Uh, yeah, it would, and remember that there's a kind of a rule of thumb for every $10 change in the price of crude, you have about a 25-cent per gallon change in the price of gasoline at the pump, and gasoline now has gone up as we speak here on the 6th of March. It's gone up roughly about 50 cents in most places, 50 cents per gallon in most places in the United States. So this is a big problem. There are all kinds of costs associated with the war. One cost is, just the cost of burning up munitions and fuel and everything involved in the attack itself, and then there are other costs, these economic costs that we're talking about, kind of the collateral damage, and needless to say, there's a huge cost in terms of loss of life of even many mostly non-combatants. By the way, they're just civilians being killed.
Can we just go back and comment on inflation one more time? You said this is not going to be a cause of inflation, as inflation is caused by monetary matters, the expansion of the money supply, not just oil. Let's just evaluate this statement here by Mohammed Al-Arian, leading macroeconomic commentator, formerly of chief economic advisor at Allianz. A lot will depend on the duration and the spread of the conflict. He says the more it spreads, the more stagflationary it is for the global economy. Um, he further outlines that the conflict in Iran is expected to lead to significant instability in energy markets, particularly oil and natural gas. Iran is a large exporter of both. So, can you just explain why higher oil prices is not immediately inflationary?
Oh, it's the Japanese example that I gave you. That's you have to goose the money supply to get inflation going up. Now, as it turns out, and we've talked about this on your program, I think that we will not get the inflation genie back in the bottle and get inflation down to 2% target in the United States. And that's because already the money supply is accelerating. I've gone through this in some detail. My big worry
Yes.
before the war, forget about the war, forget about oil, forget about
Yeah.
all of that stuff. I thought we had an inflation problem just around the corner, and the inflation genie would never be put back in the bottle. That's what I thought. And the basis for that was the acceleration that is occurring in the money supply, broadly measured by M2 in the United States, and the fact that I thought all the tea leaves that I could see were for more loosening of the money supply. In other words, bank regulations, that's affecting a huge chunk of the money that's being produced, is bank lending, and that's loosening up. They're taking away regulations, and the federal funds probably going down. Lots of pressure to loosen the federal funds. They already in December stopped quantitative tightening and started quantitative easing, David. So the tea leaves are pretty easy to read. We have the acceleration in the money supply occurring now, with bank lending actually accelerating considerably, and we have all these loosening factors going on, quantitative tightening to quantitative easing. So the balance sheet of the Federal Reserve is actually growing now. It's not shrinking anymore. The federal funds are coming down, and I think will continue to come down because of political pressure. And among other things, of what's becoming obvious to most people, the labor market is becoming weaker and weaker. We just had a report today of a lot of weakness showing up in the labor market. Something I've been saying for a long time. If you look under the hood, the labor market's weak, and the Fed and the people who determine Fed funds look very carefully at what's going on in the labor market. And by the way, go ahead.
The U.S. economy unexpectedly sheds 92,000 jobs in February. So the labor market is looking weaker, like you said. Let's talk about what the Fed may do, though. Yes, inflation is caused by an expansion of the money supply, but let's take a look at what the Fed believes. The Fed, under Jerome Powell, has been very clear in that they need to unlearn monetary policy. They don't follow the money supply. We've discussed this many times on my show. Will they actually look at what's happening currently with the oil price and reduce the pace at which they cut rates?
No, I think they're going to look at the job market.
Okay.
And thanks to Trump's tariffs, by the way, remember tariffs were supposed to increase the number of jobs in manufacturing. That was what Trump told us, and he keeps telling us. But last year, there was actually a contraction of 108,000 jobs in manufacturing. The tariffs are killing jobs. If you look at the overall non-farm employment, the number of jobs that were created last year, it was almost zero. It was 181,000 jobs in 2025. It was 2.2 million in 24. So the tariff man is destroying the job market. These tariffs, this is not, you have to look not at the narrative in the press, but in reality, look at the data. And this gets into Hanke's 95% rule. 95% of what you read in the financial press, it's either wrong or irrelevant.
Okay, I wonder how this would impact the dollar. So the South Koreans are implementing fiscal intervention right now. And I believe there was according to the president of South Korea, they announced a 100 trillion won stabilization fund to cope with soaring energy prices. Do you think, and by the way, the Asian countries, South Korea, Japan, Malaysia, Thailand, they're heavily dependent on oil imports. So how do you think, A, the Asian countries will respond, and B, their fiscal intervention, will they impact the US dollar in some way?
Well, let's talk about the U.S. dollar. This is another narrative. We have two narratives related to the dollar. One is sell America, get out of America, sell America, and the other is a de-dollarization, which we've talked about many times on your program. This is all rubbish. If you look at last year, the net investment inflow into the United States increased by a little over 31% relative to where it was in 2024. The money was just pouring into the United States. If you look at the dollar euro exchange rate, which of course is the most important price in the world, the dollar is very strong.
Mm-hmm.
What happened after the war? The dollar actually is strengthened.
Yeah.
Excuse me.
Okay. So
That statement made me sneeze even.
what? Well, what assumptions are people making that are just wrong? Assumptions about de-dollarization happening around the world.
Well, they people talk about things, but they don't look at the data. You have to look at the
Okay.
data, and these data, it's not secret data. I mean, it's official data put out by the U.S. Treasury. The number that I just gave you for the net
Mm-hmm.
investment flows last year, that's
Yeah.
and you can look there, or the Bank for International Settlements,
Right.
any place where you have good, reliable data coming out, tells the same story, that the de-dollarization narrative is basically BS.
So let's just take this back for the average American or Canadian watching this show. Should the average person be concerned about a major shortage of oil at home, at the gas pump? Are we going to see a huge lineup at gas stations, which was strong imagery that we can
Well,
remember from the 70s?
it depends. If you put price controls on, you'll see lots of lines at the gas station.
Okay.
If you don't,
Price controls meaning the government says
you
to gas
don't,
stations.
if you don't, David, the market will clear and you won't see any lines. It's just a simple supply and demand analysis. Principles of economics students can do this. If you put a price control and a cap on prices, you end up with demand exceeding supply and a hell of a big queue.
So Americans are kind of, are we, sorry, I don't mean to make assumptions for you, but are we saying that Americans are stuck either way? Either we have price controls and then we have a shortage of supply, or the market sorts itself out and prices go much higher, in which case a lot of people can't afford gas in the first place. Is that the current situation we're facing right now?
Yeah. What we're seeing right now, and I don't see anybody talking about price controls, but what
Okay.
is that the price is going up. We've already said that the price of gasoline has gone up about 50 cents on average in the United States in the last few weeks, and it will go up. It'll continue to go up because, as you just said, we had West Texas Intermediate crude hit a 52-week high today.
Yeah.
So oil prices are going up. So then the question is, well, what would I do if I was advising them?
Yes.
And I would advise dropping the sanctions on Russia and letting them offload that Russian crude that's in the shadow fleet. That would take care of the short run problem, and oil prices would collapse. There's no question about it. And then you brought up, well, it's a strategic petroleum reserve. That's yet another, shall we say, storage facility, if you will, where there is crude that could be put into the market. There's a lot of crude around that could be put into the market. Right. And the easiest one is again the Russian shadow fleet.
And I'm just wondering how the Strait of Hormuz directly impacts the U.S., given that the U.S. is currently the world's largest oil producer anyway, right?
Well, it doesn't impact as much as it did in 1978, 79, correct, which I went through. We are less vulnerable now than we were back then. But that doesn't mean that we're insulated. It just means that we're not as vulnerable, and the hit won't be quite as hard as it was in the 1978-79 oil crisis. That's all it means. But The direct consumers coming out of the Gulf, most of that goes to Asia. Most of it actually goes to China. Now, maybe, by the way, the Chinese have been buying and increasing their storage tremendously over the last year. So, maybe they saw something that other people didn't see. Maybe they saw trouble on the horizon.
You mentioned, let's talk about the stock market. You mentioned at the beginning how overvalued stock markets currently are. We're speaking today on the day when the Dow opened 900 points lower. The S&P is down 1%, and so is the NASDAQ. How exposed, either directly or indirectly, are companies within the large indices to oil prices? In other words, when oil goes up, why are stocks down? Or are they not related? Maybe stocks are responding to something else today.
Well, they are, and obviously the companies that use oil directly or indirectly are hit more than those who don't. For example, look at the airline stocks; they burn fuel, or logistic companies, freight companies and things like that. So it depends on the sector, but in general, we in 1978-79, the PE ratio was 8. Now it's 29. So that indicates there's a lot more vulnerability than there was back in 1978-79. And that means that the negative ripple effect will be potentially quite a bit larger coming out of the stock market. The wealth effect, what you're getting with the Israeli-U.S. war in Iran, you're getting a huge destruction of wealth. Remember, we said there are lots of costs associated with the thing. If you start adding it up, of course, you have the direct military cost of fuel, munitions, and all of that.
Yeah.
And then you've got all kinds of secondary costs that are economic, and one big one are the financial markets, because it's war destroys value.
Correct. Now,
and what happens with that? Let's say the stock market really does tank and the bubble pops. You get a huge negative wealth effect, and all those people that have done very well in the stock market and are keeping consumption at very elevated levels in the United States, that will disappear. So it ripples through the economy. The stock market takes a hit. Your wealth takes a hit. You start hunkering down. You don't buy another new car. You wait a year or two. That kind of thing.
Let's go back to currencies for just a minute. Sustained oil prices are having another kind of effect around the world. Central banks are having to keep rates steady. They clearly don't see inflation as a byproduct of just the money supply. They're seeing this as a real threat as well. Whether or not that's accurate is up for debate. But we know that Asian countries such as the Philippines, Indonesia are now on pause when it comes to rate cuts. And so the currencies are taking a hit as a result. If you were an advisor to one of these central banks of an Asian nation, or even another smaller country that's importing most of their crude oil, and you're watching your currency at risk right now versus the dollar, what would you advise them to do?
Steady as you go. You don't going into this in a place like Indonesia. You don't want to be loosening up monetary policy. The rupiah would take a hit. All these countries are interest rate sensitive when it comes to their currencies. And what I really would recommend is what I recommended when I was the chief advisor to President Suharto in Indonesia. Speaking of Indonesia, they wouldn't have this problem if they would have done what I recommended and what Suharto wanted to do, and that's put in a currency board where the rupiah would be issued. It would be fully backed by the U.S. dollar, would trade at a fixed exchange rate with the U.S. dollar. It would be a clone of the U.S. dollar. They wouldn't have a currency problem. The rupiah would be just like the U.S. dollar. It would be like the Hong Kong dollar. The Hong Kong doesn't have a currency problem. In fact, the Hang Seng market, by the way, was up today. It's one of the few markets that was actually up. And one of the reasons for that is that the Hong Kong dollar is issued by a currency board. It trades at a fixed exchange rate, 7.8 Hong Kong for one US, and it's backed 100% with US dollar reserves. So the Hong Kong dollar it is a clone of the US dollar.
By the way, how is China reacting to this? An estimated 40 to 50% of China's total crude oil imports pass through the Strait of Hormuz, which is now closed. And so
Yeah,
either
yeah,
the Strait is
they
closed.
actually have two straits they have to go through. The more oil flows actually through the Strait of Malaga than the Strait of Hormuz. A little bit more, not too much more. So the oil coming into China from the Middle East has to go through two straits. And right now, Malaga's fine, but
So unless we can assume that somehow the strait is closed to everybody except China, which was a friend of Iran's, then we're going to assume that China's crude supply is going to take a hit. How would they cope with this? And how do you expect China to act or intervene
oh,
somehow
the,
in the Middle East?
the,
Yes.
the, well, try to do what all the Gulf states are trying to do, what everybody wants to do. The Turks, the Gulf states, Russia, China, they all want to shut the war down. I mean,
You don't think they're going to participate in the war and escalate this?
I don't think they will let Iran fall. China. You're asking about China, and I
Yes,
don't think
yes.
China. I don't think China will. I think they will do whatever they have to do to preserve the regime.
Which may or may not involve directly being involved militarily, or perhaps that's too far.
I think they'll do whatever they have to do.
Okay. Do you see this conflict then spiraling out of control to beyond the Middle East? In other words, beyond a regional war?
Well, it depends on how you define spinning out of control beyond the
Yeah,
Middle East.
sure.
The way I see it, it already is.
All right. Uh, I mean, does it impact? All right. Well, we're all speculating here, and we don't know what's about to happen. But the foreign ministry of Iran said they're ready for an American invasion should troops be placed on the ground. I mean, there's no report of that happening right now. But does it come to that? You think?
Well, there's a lot of speculation now about whether the Iranian Kurds who are
Yeah.
in Iraq, in northern Iraq, whether they're and there's a very mixed picture. The U.S. says that they're getting them ready and so forth and so on, and the Kurds say they're not. So it's something you keep your eye on it, because if there are troops on the ground, the proxy would be those Kurds, probably.
Okay.
And it's a very murky picture what's going on. There's a lot of the fog of war. We're getting into something where the only thing we have is kind of secondary data. We're not at the control tower, David, and as you say, we're speculating based on secondary data and our experience with this kind of thing. But we're operating in a fog of war, so we just don't know. And there's an interview with one of my old friends. We served on the International Advisory Board of the National Bank of Kuwait together. Prince Turki Al Faisal, who was the head of Saudi intelligence, also former ambassador to the United States. there's an excellent interview with him that I actually put it up on my Twitter at Steve_Hanke, in which he basically said that Trump doesn't know what he's doing.
In regards to what? Foreign policy or executing a war?
The war, the
Okay.
whole thing, the subject we're talking about now. You've got. It's one thing to have the blind leading the blind, but when the
Right.
deluded are leading the blind, you really have a problem. And that's basically what Prince Turki Al Faisal had to say. And as I say, I know him, and I respect his judgment on these things. So that's how you have it.
Well, what do you
And
think is
you have to
Trump's?
you have to
Yeah.
remember, you have to put this thing into context. So who's telling who what to do? Well, it's very clear the Israelis are telling the Americans what to do. And this comes back to a very important fact, and that is the politics of the thing, and that is the Israeli lobby in Washington D.C. is very powerful. And if you want to read up on that, 2007, a classic book was published, The Israel Lobby and U.S. Foreign Policy, by my old friend John Mersheimer at the University of Chicago and Stephen Walt at Harvard. It's a scholarly book, but they pretty much lay it out. Who who calls the tune in Washington is the lobby. So to figure out what is going to be happening, you really have to look to see what's happening and what they're saying in Jerusalem and Tel Aviv, not Washington D.C.
So that leads me to my next final question, which is what does the Americans want for their final objective? The Ayatollah has already been executed. Most of the commanders, if not all, of the Iranian Revolutionary Guard Corps have been destroyed. And so a regime change is already underway. What else needs to be done? What else? Why does
Well,
it need to
well,
last a few more weeks, and
well,
if not months?
you're acting like it can occur. Let me refer you to Lindsay O'Rourke's 2018 book, Covert Regime Change, published by Cornell University Press, another scholarly book.
Yes.
O'Rourke, by the way, received her PhD from Mersheimer at Chicago, but she goes through all of the regime change attempts that the U.S. has been involved with since World War II, and uh, about 60% of them completely fail. There's
Okay.
no regime change, and the other ones are are left in a complete state of chaos and a mess. So that's the history of regime change. It's a completely disastrous policy. So it's going to end in disaster one way or another. Uh, we don't exactly know the outlines of it, but
Well,
if history is a guide, it's going to fail. So the U.S. has been entrapped into a policy that is
right.
going to probably fail. Point number one: forget the spinmeisters in Washington D.C.
Yes.
And uh, that's where we're left. And there's a lot of debate about what actually the objectives of the United States are, because Trump keeps changing the objectives. It's one thing, then it's another thing, then it's another thing. This has been a rolling thing. But the
Mhm.
ultimate thing is the Trump will do whatever Netanyahu tells him to do.
How much of all of this, starting from the beginning of January with the capture of Maduro in Venezuela, has to do with curtailing China? So first they captured Maduro, and now they're taking control of Venezuela's oil fields. Venezuela, previously again friend of China, and now Iran. Could the U.S. be positioning to take over Iran completely, control the Strait of Hormuz, and basically cut off China to oil?
Well, I mean that, as they say, that is a scenario, but I think it's better to look at the first order conditions rather than the second and third. China is affected by this. There's no question about it. But this is a second or third order kind of thing. The first order in Iran is for 40 years. Netanyahu wants to destroy Iran, and and he basically got Trump, because Trump, supported by the lobby, to engage. There's no way Israel could do this on their own, by the way. No way. This is a big U.S. operation.
Okay, we know how it benefits Israel.
Basically, the U.S. is fighting Netanyahu's war.
So how does this benefit the U.S. strategically, fighting Iran?
Well, I think the list of possible benefits is very short, and the list of the costs are enormous.
Yeah. Okay.
Because among other things, we haven't gone there in the cost items. One cost I didn't mention will be the political cost. The American public is very negative on this, and I think the Republicans, led by Trump, will take a real beating in the midterm elections. So the political fallout will be big, and the long term will be massive, because the contrary to the spin in the United States, the supreme leader who was assassinated will go down in the Muslim world as a martyr, and there are a lot of Muslims. That means that the Muslims will be enemies of the United States almost by definition, for as far as the eye can see. So we're creating a huge number of enemies.
Potentially, but also maybe strengthening alliances with other Muslim nations. Saudi Arabia, Qatar, the UAE was hit as well, right? Kuwait.
I think let me refer to you to Prince Turki Al Faisal's interview.
Okay.
You'll get a pretty good idea of
Okay.
what they think of the Gulf states.
All right. Let's wrap it up here, Professor. Very good update. Thank you very much. We can follow Professor Hanke in the links down below. I'll put your X account. How many followers are you at now, Professor, on your X? Over 800,000.
837,000.
So please follow Professor Hanke there, and you can write to us. I'll put our emails down below as well. If you have questions for our next interview, Professor Hanke comes on regularly, a couple times a month. So thank you so much for your updates today, Professor.
We have, by the way, we get very good response from our viewers. Ask very, very interesting questions, and we both of us appreciate that response and engagement that we have with viewers.
Absolutely. Okay, good.
You got to satisfy, David. You got to satisfy the customers. The customers are our viewers.
Yeah. And we want to hear from the customers. We want to hear from the viewers. We want to hear from what they have to say. So write to us. Tell us what you want to hear for Professor Hanke's next interview.
You know, a great line that a good friend of mine who made a huge fortune in banking, Vernon Hill. Vernon has a book out, and the main line in there is that I don't want fans, I want customers.
I don't want fans, I want customers. Yeah, because I'm guessing the customer comes back regularly. Well, please do come back again regularly. Write to us and follow Professor Hanke down below. We'll talk about Professor Hanke's book in more detail next time as well. Thank you so much, Professor. Speak next time.
Okay, thank you, David. Have a good day. Thank you.
You too, and thank you for watching. Don't forget to like and subscribe.